Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Hari. We are going to be talking about current events as it relates to the United States and what it means for your portfolio. Before we get started, we're going to do a little disclaimer here. This is the Value Investing TV podcast. We are a podcast designed for educational and entertainment purposes. Anything we discuss on this podcast is not discussed in relation to your specific financial situation, or we don't know your specific financial needs. So if you are making any financial decisions, please consult with the appropriate advisor before making any decisions. All right. So in the last episode, we kind of talked a little bit about how China is being impacted by Evergrande and slowing growth and other things that are going on, especially related to default. But a lot of those same things actually apply to the US in different ways. One of the biggest things that is kind of flying under the radar for a lot of people or unnoticed was how much inflation we've had for the last year and a half. So inflation occurs when you inject too much money into the economy, which happens with, the traditional way you think about that, which goes back all the way to, Roman times, is that you print too much money. So you make too many gold coins or you devalue the currency. Essentially what happens is people need to spend more money to buy the same amount of goods. There are different ways that you measure inflation, but the consumer price index, which is a basket of goods, is the traditional economist way of measuring things. And so what that really does is, if your income is growing up, but it is growing at a slower rate than the rate of inflation, in practical terms, you actually have less money than you did before. And where this actually was a real problem was in the late 70s and early 80s, when we had what was called stagflation, when we had stagnant growth in terms of GDP growth, and we had inflation. And so the inflation really started here when we started fiscal stimulus due to the coronavirus pandemic under Trump, and then it was extended with Biden with I think it was originally $1 trillion, and then it was $2 trillion. And so when you inject that much money into the economy people aren't working for it, they're just getting a check of, an unemployment benefits and so on. It creates the value of money gets decreased, for every dollar that you have spent, that now is more like 90 cents, in original terms. Since the 1970s, the value of the dollar has kind of decreased by like 80%, right? So a dollar in the 1970s is now worth about 22 cents or so. What that really does is, it hurts the people that it hurts the most are actually the middle class and the poor, because they don't have the ability to, expand their growth, their wealth, because their jobs are, for the most part, are commodities. They're easily replaceable. So that ends up meaning that their wages are kept down. What we've seen is actually a lot of job postings are available, but a lot of people haven't gone back to work because there is stimulus that's allowing them to stay unemployed, and they make as much money or more money by not working. And so this creates this huge gap between open jobs and jobs that need to be fulfilled. And so what that does is it stagnates growth. And then on top of that, you add income, or you spend more money. And, as this weekend, there's been discussion about Biden's $3.5 trillion stimulus that he is planning to unleash. It hasn't been approved yet, but that would be another source of inflation. So what does that all mean? Well, when you combine all of this stuff and you have stagnant growth, this is the recipe for a recession, and we've been 12 to 13 years now removed from the 2008 recession, and normally we have 1 to 2 recessions per decade. We're now 13 years since the last one, and we have been able to maintain our growth by lowering the interest that the Federal Reserve charges, intra-bank interest rates. And what that does is it lowers the interest rates all across the board for borrowing money, which makes it easier to borrow money. And so people use that and put more money in stocks and so forth as a result. Well, the Fed is actually now starting to reverse that because of the amount of inflation that they're seeing. But when you start reversing that, that actually creates a huge problem for the stock market, because when the interest rates start to rise, money isn't as cheap anymore. People start pulling their money out, and then they put it in bonds because bonds are safer than putting it into stock investment. So there's a huge fallout that could occur here as a result of these policies. So some of the biggest things that we as investors need to be mindful of is if these Biden stimuluses get passed, rather than just getting people to go back to work, and we start spending $3.5 trillion on large government stimulus, inflation will happen, right? It's already happened. It was a big problem. We talked about it when the first stimulus was passed, and now we've actually seen the outcome of that. And growth in certain areas has been 3 to 5% in terms of inflation. So that's the real pricing power has kind of fallen apart. And so, I mean, you've probably even noticed it with, if you're going to a restaurant, restaurants are raising prices. A lot of that is due to combination of factors, not just the stimulus, but supply is constrained as a result of the global supply chain has been impacted by COVID. Large areas of the world have, significant lockdowns. Those lockdowns mean goods are not being sent out. And as a result of that, the prices of, semiconductors, things like that are going up. And a lot of people are saying in the next year, it may not, relieve until the fall of 2022. So think about cars that are sitting on car lots waiting for chips to go in them. The price of your computer, your tablet, and so on are more expensive because there's such a supply constraint there. And it really affects almost everything. So what is end up happening is people are moving their money into gold, crypto, those kind of things, because that has been a focus for a long time. And you've seen Bitcoin has gone up into the 40,000 up to 60,000, I think, when it peaked. And so a lot of this movement away is for people as an inflation hedge. They're moving their money into areas like Bitcoin. So what does that all mean, for us as investors? Well, there's a lot of things that you can do here that you can sit on cash and wait for the right pitch, which is always a valid, approach. A lot of people take the idea that you have to either be, fully invested at all times, or you have to have, but if things are looking bad and, sitting on cash is not necessarily a bad thing, as we're going to see, I think, some significant volatility as the Fed starts moving. And if they start raising interest rates, I think people will be pulling their money out of the stock market. So I'm always in favor of looking for stocks in any market and keeping that list, together. That way, when a fat pitch does come, you're ready with cash and you can take a swing at it. And so right now, even though things are relatively calm, not great, but relatively calm, you can start making your list of great businesses, putting those businesses through the ringer, and then if they make the cut, you watch for when the prices fall, and when the price falls below your value, your margin of safety price, you buy. So what I would say is, as always, the best approach is always to start with looking at these investments now, even when things are good, keeping that list and growing that list to find the best stocks. And then when the time is right, you may have 10 or 20 or 30 stocks on your list, and you're going to base it on what is the cheapest, what has the best opportunity for the next 3, 5, 10 years to continue to grow, and use that information as your jumping off point for making portfolio decisions. So nothing is really changing here, even though we're talking about all this stuff and you may not understand all of the macroeconomics and that kind of thing. Main important thing is to always be looking for individual investments, because great companies do go on sale occasionally. And when they do go on sale, it is important for you to be ready to strike and invest. So switching gears here a little bit, we're going to just, if you have any questions or concerns about this topic, or you want to ask us to cover a company on the next podcast, email us at info@valueinvestor.org. We'd also really appreciate it if you liked, comment, and subscribed on this YouTube video, because that helps us grow the podcast, get more listeners, get more people to join. And as we grow it and we add, resources, we'll be able to do more things with it. So we really appreciate, all of the comments, and, everybody's, messaging us and, asking us to cover this. Last week we covered DraftKings. And this week, several people have asked us about China and the United States. So we kind of covered that, in this podcast. But if you have any of those requests, please email us info@valueinvestor.org, and we'll be happy to, take them into consideration as we go through the next, the backlog of episodes. So yeah, that we'll call it a day there, and we'll look forward to talking to you on the next podcast. Thanks for your time, and we'll see you next week. Bye.